I listen to a bunch of Bitcoin and macroeconomic podcasts, and I always hear from the hosts about how gold's price is being manipulated. And whenever a podcast host says something like that, I've always wondered what it meant. How could gold, a $12 trillion asset, have its price manipulated? So I dug around on the internet and I found out why some people think the price of gold is being kept artificially low. And the supposed manipulation revolves around the futures market and the creation of paper IOUs for gold. The main characters in this story are central banks and other large banks known as bullion banks. But why would they want to keep the price of gold down? And that's when I learned it's not about gold at all, it's about the US dollar. When the dollar is doing well, the price of gold usually goes down. And when the dollar is down, the price of gold goes up. So if you could somehow keep the price of gold down, it would make the dollar look stronger than it was. And a strong dollar is good for the US economy because it helps keep things like interest rates and inflation stable. But how is this manipulation of the gold price even possible? One way to keep the price of gold down is by selling something called a futures contract. And in this case, you can think of a futures contract as a promise to buy or sell gold at some specific price in the future. And these contracts are often used to gain access to gold held by commercial banks. And when a bunch of these large institutions start to sell these futures contracts, the price of gold goes down. This is often done by bullion banks, which are large banks that deal in large quantities of precious metals. And this isn't just some crazy conspiracy theory. Gold price manipulation is a well-documented phenomenon. In 2014, Barclays got fined $44 million for failing to prevent traders from manipulating the London gold fix. And in 2021, JP Morgan paid $60 million to settle a lawsuit from investors who accused them of intentionally manipulating prices of precious metal futures and options contracts. But price manipulation isn't something that's done out in the open. There's rarely proof that it's happening. Instead, people often point to patterns in the market as evidence. It's like a puppet show where you can't see the puppeteers, but you can see the strings if you look close enough. Gold bugs point to sudden drops in the price of gold as proof of manipulation because they claim that these drops are too big and happen too fast to be natural. So that's the argument for why some people think that the price of gold is being held artificially low. They believe that big banks are pulling the strings behind the scenes to benefit themselves and the US dollar. But like any theory, there are people that disagree, which brings us to the arguments against the idea that the gold price is being suppressed. Some people argue that all markets, including gold, get influenced by big players. They would argue that this is fundamental to markets. Large investors can move prices if the size of their trades are big enough. This isn't unique to gold, and it doesn't necessarily mean that the price is being suppressed. Another point to consider here is the role of the Federal Reserve. While it's true that the Fed's actions can influence the price of gold, it's not always in a downward direction. When the Fed cuts interest rates like they did back in 2008, it often leads to higher gold prices. Lower interest rates reduce the yield from bonds, making gold and risk assets more attractive investments. And one of the biggest arguments against the idea of gold price suppression is just a lack of evidence. While there are instances of market manipulation in the gold market, like the spoofing scandal a few years ago, these are generally seen as the actions of rogue traders rather than an organized effort to suppress the price of gold. Finally, some people argue that the idea of gold price suppression is a scapegoat for when price predictions fail. In other words, when some gold guy tells you that an ounce of gold is going to be worth $5,000 or $10,000 back in 2010, instead of admitting that they were wrong, cognitive dissonance kicks in and they start to make up all of these excuses for why their prediction didn't come true, including gold is manipulated by this giant cabal of insiders and banks and people across the world. So while the idea of gold price suppression is compelling, it's important to consider that the reality might be a little bit more nuanced. Next, let's consider what all of this means for investors. If gold price suppression is real or perceived to be real, it could have a big impact on investor decisions. Investors would see gold as a good opportunity, expecting the price to rise sharply once the suppression ends. The theory being that if there's all this downward pressure forcing the gold price down, once that bubble pops and that downward pressure can't be applied anymore, the price of gold would shoot to the moon. But if the suppression theory is fake, then maybe we've been seeing the true value of gold based on its economic fundamentals this entire time. And what would happen if there was another form of digital gold that could serve as a better store of value and medium of exchange? Bitcoin, unlike gold, has a finite supply. There will only ever be 21 million Bitcoins mined. This scarcity makes Bitcoin's investment thesis very similar to gold's. But unlike gold, Bitcoin's supply is finite and it's based on code that can never change. Bitcoin is easy to store and move around, making it easier to use in transactions. And while gold's supply can increase, Bitcoin's supply is immutable. This distinction is really important, so pay attention. If demand for gold went up 1,000%, gold miners would just go mine more gold. The extra mining would increase the supply of gold at the same time that the demand was increasing, which would keep prices flat or even push prices down. However, if demand for Bitcoin goes up by 1,000%, there's no way for the miners to mine any more Bitcoin. This increased demand with a static supply would cause the price of Bitcoin to go up drastically. And we've seen this play out out over the last 13 years when you compare Bitcoin's price appreciation to gold's price appreciation. Since May of 2013, Bitcoin's price has increased about 25,000%, while the price of an ounce of gold has increased by only 25%. And even over smaller time horizons, we've seen Bitcoin massively outperform gold from a price perspective. Of course, no investment is risk-free, and this is not financial advice. Bitcoin's price is very volatile, and that can make it a much more difficult asset to own just from a peace of mind perspective. But over an extended period of time, Bitcoin's returns speak for themselves. That being said, everyone's risk tolerance and investing goals are different. The amount of Bitcoin or gold or stocks or bonds or real estate that you should own is going to be different than the amount that I should own. What's most important is that your investments reflect your knowledge. You need to understand what you're investing in so that you can make a better decision about your financial future. If you found this video helpful, check out this video over here to learn more about Bitcoin, and check out these videos over here to learn more about macroeconomics. I love you all. See you next week.